Let's consider what happens if we invest, say, 2 million rand into a share portfolio, such as a basket of unit trust shares, and we draw income. We may expect a slightly higher return compared to a bank fixed deposit investment, and we may also be attracted by the fact that a share investment may be more tax-friendly than a bank investment. Let's say we expect 9% return and we start off drawing 15,000 Rand per month initially, but escalating at 5% a year to keep pace with inflation. Obviously, there would be costs and commissions involved. If we click on the default rates button at the bottom of the screen, we can adjust fees and costs. We've entered 300 Rand initial cost of registering the investment, a 2% annual dividend, a 1% annual portfolio management fee, and a 1% trail commission. You can change any of these figures to whatever you wish. If the investment company you're dealing with says that the returns they publish are after any costs, then you can make everything here zero. We will discuss tax on income and on any interest portion in a moment, but first let's have a look at the table displaying the cash flow. In the first year, we draw 180,000 Rand income, and at the end of the first year, our capital is slightly more than 2 million Rand. What the program does is it goes through month by month, adding the nominal growth, subtracting income, subtracting fees and commissions, etc., and adding the annual dividend, exactly the same way that the financial institutions do it. If we look at the amortization table, we can see a month-by-month account of the 15,000 Rand we are drawing every month and how our capital changes every month. In month 13, we can see that the monthly income we draw increases by 5%. If we scroll down to the end, we can see that we will be drawing this inflation-linked income for 15 years and 8 months before we run out of capital. Now let's talk about tax. When you draw income, what actually happens is that the investment institution sells some of your shares to pay you the income. Any profit you made between the price you originally paid for the shares and the selling price is subject to capital gains tax. In the first year, you sold shares worth 180,000 Rand. When you bought the shares a year earlier, you would have paid about 166,000 Rand for them. At 9% growth, 166 Rands worth of shares would have grown to about 180,000 Rand. This means the profit you would have made eligible for capital gains tax is 14,000 Rand. The good news is that the first 40,000 Rand of any profit for capital gains tax is exempt from tax. You would have to draw an amount of income large enough to make many hundreds of thousands of Rands in profit before even a very small amount of capital gains tax would be due. In year 15, we sold over 350,000 Rand in shares, and these shares cost us about 92,000 Rand when we bought them 15 years earlier. That is a profit of 258,000 Rand. The annual exclusion is 40,000 Rand, and 40% of the balance is added to income for ordinary tax. 258,000 less 40,000 is 218,000, and 40% of 218,000 is 87,200 Rand. Only 87,200 Rand would be added to income for tax, and as the amount of 87,200 Rand is way below the tax threshold, there's no tax due. The specialist analysts managing unit trust funds have uncanny skills they use to plot and predict market movements, and they shift money around to ensure the very best returns for the funds and ultimately for the investors. In cases where these analysts think that share portfolios look like they may temporarily suffer poor returns, then your money may even be moved to bank investments for a while, where your money may be subject to ordinary bank investment rates and earn interest. This interest will be passed on to the investor as normal taxable bank interest. If you have R1 million of your money moved to a bank investment account temporarily for a month where it earns 7% per annum, then your R1 million will earn 5,833 Rand in ordinary bank interest taxable in your hands. As the first 23,800 of bank interest for not yet 65s and the first 34,500 of bank interest for 65 and older is exempt from tax, you can see that you would need to have a lot of money moved to bank investments for a long time for the interest to become a factor.